This week on Wealth Track, our annual exclusive with Wall Street's long-reigning economist king, ISI Group's Ed Hyman, and BlackRock's lord of large-cap stocks and strategy, Bob Doll. What do these great investors see in the economy and markets in the year ahead? How are they investing? Find out next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this first 2012 edition of Wealth Track. I'm Consuelo Mack. One of today's Wealth Track guests, BlackRock's Bob Doll, describes 2011 as frustrating, volatile, and disappointing for most investors. Well, what's in store for 2012? With that kind of a foundation, we can only hope it will be better. As the Financial Times reported, $6.3 trillion was wiped off global stock markets in 2011, a 12.1% drop. Now, the U.S. actually put in one of the better performances, which is not saying much. Yes, the Dow was up 5.5%, but the S&P 500 was essentially flat and the NASDAQ was lower. And as you can see from this chart, the ringer the market put us through to get there was barely worth the trip. The earth-shaking Arab Spring movement, the real earthquake and tsunami in Japan, rising unemployment and tepid economic growth here, the string of seemingly ineffective bailout deals in Europe, failed debt reduction deals in Washington, and the downgrade of U.S. debt all contributed to the worst market volatility in decades. Meanwhile, corporate profits and cash levels are at record highs. As Wealth Track great investor Hirsch Cohen recently wrote to his ClearBridge Advisor clients, the biggest issue for the markets is not the jobless rate, the European debt, or the possible slowdown in China. Rather, it's the remarkable and disturbing volatility of all the financial markets that is most responsible for keeping both individuals and professional investors either very cautious and or out of stocks entirely. Well, what are we in for this year? As we have in the past, we are delighted to begin the new year with the man institutional investors have voted Wall Street's #1 economist for 32 years in a row, who was recently named to the All-America Research Team Hall of Fame. He is ISI Group's co-founder and chairman Ed Hyman, who appears on Wealth Track exclusively every year. He is joined by a longtime member of Wealth Track's Brain Trust, Bob Doll, chief equity strategist at BlackRock, where Bob also oversees 3 highly regarded large-cap mutual funds, BlackRock's Core, Value, and Growth funds. I began our discussion by asking them what are the biggest changes they expect for 2012.
I think if it's different, and I'm not sure it's going to be, but if it's different, it's going to be better. There is a small chance that the economy could do a lot better in 12 than it did in 11. It's not my best guess, but if it was really different. The economy right now, as you know, is doing remarkably well every week.
You told me it was a miracle about how well the U.S. economy is doing.
Well, maybe that was before Christmas. The economy every week for 3 months has done better than expected every week. Every day has been the same, and so far this week, it's again the same. For example, consumer confidence that they come out with on a daily measure, if you could believe that, has gone up significantly in the past 3 or 4 weeks with the stock market. So if I had to answer your question about what could be different in 12, it would be that the economy would surprise us on the upside.
Where is the strength coming from?
The strength is very broad-based. and somewhat mysterious, but the consumer is spending. Employment is picking up, and of course those two come together, and then consumer confidence picks up, which I mentioned is happening, and credit expansion is occurring, and pretty much there you have it. They had a report out this morning that lending to small business was up 18% year on year. So you have credit, you have employment, consumer spending, confidence, and that's creating an economy that is doing better. And as all of your guests will tell you, don't get too excited about it.
Because it could end.
No, because it's not doing great. It's just doing, better. And I would say, looking back at the past, 3 years we've been growing, the economy, in hindsight, when they write the history, it will be doing okay. Not great, but if it's better, if it's different in 12 than this year, I think it'll be somewhat better.
All right. Bob Dahl, economy is going to muddle through one of your famous 10 predictions that you come out with every year. How do you feel about what Ed's saying? Do you agree with him?
I do, but you notice how he started, is that if it's better. And I would agree. I think the probabilities are not all that high. I think we will be in a muddle-through world. But if it's not that, I think the probability is that it's better than we saw last year. But that's the U.S. The rest of the world is, at the moment, most places slowing down. While the U.S. is going the right direction, Europe for sure, in a recession, many parts of it. Asia still slowing down in lots of places. So we have a divergence going on in the world at the moment, and I think that'll be very interesting to watch. Does the U.S. help the rest of the world do a little better, or does the rest of the world slow the U.S. down?
And your best estimate guess is?
That the U.S. will slow down. The U.S. accelerated during the course of 2011, the fourth quarter being the strongest. Let's call it 3-point-something% real GDP. I don't know how many threes we're going to get in 2012. I think we'll average 2 to 2.5. So my message is, when you get to 3, don't extrapolate 3 forever or 4 or 5 any more than when you get to 1, which we might have a 1% quarter in 2012. Don't forecast a recession. We're going to average 2 to 2.5, and economies never grow in straight lines.
So let's talk about the impact that could have on the U.S. stock market specifically. And if you look back at 2011, we had a tale of two markets. The first half was decent and pretty good, as a matter of fact, and the second half it just kind of fizzled. So what, and as a matter of fact, I quoted you earlier saying that 2011 was frustrating, volatile, and disappointing for most investors. What do you think it's going to look like for most investors in 2012?
Probably more of the same, but a positive tone on top of that. I'd be disappointed and surprised if we didn't have a better year for stocks here in the U.S. It comes back to the things that Ed was talking about for the economy, allowing earnings to be pretty decent, and the fact the rest of the world is slowing. So you have non-U.S. investors saying, where am I going to put my money? And the U.S. all of a sudden becomes a more attractive place to go. That is part of the reason the U.S. stock market, while flat in 2011, was far better than almost any other market in the world. Many of them, as you know, down 10, 20 or more percent.
So Ed, the impact that Europe, for instance, is going to have on the U.S. economy, and when you and I had talked earlier, you said that basically the Eurozone is a nightmare. I mean, how nightmarish is it going to be?
Pretty nightmarish. The problem is that the peripheral economies, the smaller economies in the South, are clearly weakening. And we are applying significant fiscal drag, tax increases, VAT hikes, and spending cuts on these economies, all in the name of it's going to get better. And it may not. I worry that it gets to be a nightmare, and the economies get worse, and you say your deficit's worse, and so you have to have more medicine, more spending cuts, tax increases. And I'm not throwing rocks at policymakers. These are very difficult trade-offs that are being made, but it looks very problematical I read Bob's 10 surprises frankly, with great interest, Bob, and I noticed that you have the Eurozone crisis could be easing. Yes. The economy's continuing to deteriorate, which I think is quite plausible. But Europe is a real question mark because of this negative mix between the economy's doing worse and fiscal drag being applied to it. And so that's a dark part. The sister to that is that inflation is going to slow, or is slowing, and I think there'll be a round of easings globally during 2012. The Eurozone, hopefully
is right
on ECB front.
Yes,
it's starting,
and the inflation easing would be a big positive. And then over on the other side of the world for China, which is also starting, but if you could get a full-throated roar of easing in both Europe and China, that could make a big difference.
So let me ask you then about your outlook for China, because I know ISI Group has a strong focus on China and has for several years now. So the hard landing, soft landing, what's your...
I'm, on Europe, I really see a dark picture. On China, I really don't. I think that they face problems, but they are able to deal with them in ways that Europe has no chance of dealing. So they can do fiscal stimulus. They could start tomorrow. In fact, could start tomorrow. And they have plenty of room on monetary policy. They have $3 trillion in cash reserves. They have a huge labor force, in poverty, 500 million people. And so they have these assets, attributes, plus a steely determination to win economically. Whereas in Europe, you have a lot of political crosswinds that make it difficult to say, this is our goal for 2012. In China, they have that ability. So, Consuelo, maybe I'm wrong on that. But compared to Europe, I'm much more relaxed about China than I am about Europe. And
so to your point, to Bob's, one of your predictions being that you think that the Eurozone crisis actually eases. So where the optimism, where is it coming from?
It's just less bad news, Consuelo. I don't think Europe solves its credit problems. I just think it finds a way to continue to muddle through while the economy is in a recession. I agree with Ed. You can't get unity in Europe, austerity in Europe, and growth in Europe, and they need all three. They are mutually exclusive, and so there's a problem that's ongoing. My view in that prediction is we make it through. We muddle our way through without the euro collapsing. That's the first prediction because it's the most important. If we get that wrong, a lot of the other things go kaflooey, if you will. So Europe has to hang together from a financial standpoint. And I would further amplify to say that we think recession in Europe stays mild if there are not significant financial busts along the way. And that will not be sufficient to drag the US down. The difference will be if we have a financial contagion because there's a financial break, then that could bring the rest of the developed world down. We think that's a minority probability. And then back to China and India, we think China and India make up more than half of the world's growth in 2012. And if you add the US to it, China, India, and the US, it's more than 2/3 of the growth on planet Earth in 2012.
So that's a positive. So that can offset the drag of Europe.
To some degree.
Well, I would think that the economies in Europe are pretty bad. I mean, a severe recession would be my...
Oh, really severe recession?
Would be my base case. I think that the point you raised, that the credit markets could be in their worst moments in here.
Absolutely.
You could get a difference between the credit markets going through their worst part and the economy. But one thing that I'd like to get on the table for the three of us here is that, and get your reaction, is that in all this, for investors, rates are zero. The alternative
That's
is
So
pretty
talk
bad.
to me about this.
We'll talk to Bob about
Right.
this.
No, the alternative of them of rates increasing.
Rates aren't increasing.
All right. Rates are not increasing.
They're not
You heard it
increasing.
here. All right.
There'll be cuts in ECB, but they don't have a lot. I guess 100.
That's about all.
100 basis points, 1 full percentage point to get to zero.
To get to zero. And China has room. And then all the emerging economies that tightened will be easing, like Brazil. But rates in Europe and the United States will basically be zero.
So what were you referring to as the big risk with rates?
What Ed was saying is the alternatives. You can invest in cash, but you have, in this country, zero, many other places not far from, and maybe heading in a lower direction towards zero. Fixed income, meaning out the yield curve, you don't get much of a return.
Right, out the yield curve, meaning that longer maturities.
Right. So therefore, do equities backdoor way of saying, if I'm going to make some money, maybe that's where I need to go. And what I would throw on the table to add to that is, what is in the price? And my view is, with the cheapness in most equity markets relative to inflation and the government bond markets, some bad news is in them, a left tail event, if you will. And if we skirt through the year without having the big bust, earnings and economic growth, modest as it is, should allow these assets to do a little better.
Can I just mention one thing, and that is if you are a fixed income investor, for instance, and let's say the 10-year Treasury note, which was up 17% last year, let's say it goes from around 2% down to, let's say, 1.5 or something like that. That is a big jump in capital appreciation. So you might not be getting income, but you're sure getting capital appreciation. So it's not all negative, right, from a fixed income point of view, if you're looking for the capital appreciation aspect, if rates go down even from these low levels, right?
True, but I think to get from 2 to 1.5, you have to have a pretty bad world. Right. Maybe worse than we're describing. Not the mainline scenario in my mind, allows rates to begin to think about moving up. Not because we have inflation, not because growth is too strong, but because the crisis premium that's in markets slowly lowers a bit, and that could allow rates here in the U.S. out the Treasury curve to move up a bit.
All right, in which case you lose on both ends if you're a fixed income investor.
There's one of the great, because this is the beginning of the year, one of the great things you go through at the beginning of every year is looking at what did the worst last year and then pondering whether you want to buy that. And bonds, the biggest winner last year were bonds, were Treasuries. Bonds. And if my view of the U.S. economy is correct, that it is, pushing ahead, I find muddling a little too
weak.
Muddling, but if it's pushing ahead, and if the stock market is doing what you think it's going to do, bond yields are not going to go down. They're going to go up, and they will be cheered by everyone except those that happen to own them. Now, there's still money in fixed income on spread products, high-yielding products that might do well in that environment. But when I look at it, I would see yields more likely to be 2.5 than 1.5 in your framework.
So stocks then, Ed Hyman, looking around the globe, you and Bob, stocks then are, do you think, the asset of choice on their own merits or just relative to what you could get in other?
I think both.
Both.
But it's a very difficult environment, as we've, I think, done justice with the Eurozone crisis. It's really sort of unknowable and has, as you point out, has a political overlay in addition to an economic overlay. And that makes it's a difficult environment. But in that environment, when I look at what I would do with my own money,
yes,
I say, well, if I can put it in cash, well, that's nothing. The next step would be to buy treasuries, and I don't want to do that. So then I'm out, buying munis or high-yield corporates, and then you get to the sort of stocks that you're recommending, which look to me like a better place to put money for a year, and I'm not going to get rich doing it. But there's a chance I might do well, and it's better than keeping it in cash or in bonds, in my view.
And the downside risk to the stock market, which is what so many investors have been so troubled by, especially given the volatility that we've had this year. So the downside risk, you think, is limited in the stock market?
At these valuation levels, I would say yes. Now,
All right.
if someone presents a scenario that says Europe's going to go bust, the euro is going to disintegrate, well, you don't want to be in stocks, no matter how cheap they are.
Right. So if you're really risk averse, then stay that way.
Absolutely right. But you're not going to get, in my view, a risk reward like we see today that's as interesting as it is. Having said that, I'm going to agree, best house in a bad neighborhood. We may not get a great return out of the stock market, but I think we'll do better there than most common alternatives, cash and most fixed income.
And your specialty, of course, is large cap stocks. So do you think that the large cap space, the big multinational, high quality, kind of dividend paying type stocks, are those the ones that are the most attractive?
Generally, although I'll modify it a bit, I think we're in an environment where, because the U.S. economy is growing and most of the rest of the world is deteriorating, you want earnings domestically. They're the ones that are going to do the best, and that generally takes you down in capitalization. So I'm not convinced that high quality small and mid cap stocks aren't going to be the best place to be. The overlay, whether it's small, mid, or large, is the cash flow question. Dividends, yes, but I'd much rather go after cash flow. Tell me if the company is going to have an acceleration in their free cash flow. If so, I get a whole lot more interested.
And why is that so important, Bob?
Because we're in a slow growth world, and in a slow growth world, you want companies that have flexibility. You want companies that have extra degrees of freedom, as I call it. And if I have accelerating free cash flow, I have the opportunity to do all kinds of things. I can buy my stock back. I can increase the dividend. I can buy the company down the street. And you know, if there's a business proposition out there and I can go invest, hire a worker, modernize a plant, I might do that too. They're the companies I think that will do the best because they have the flexibility.
And actually, for the last year, the ones who have been buying back their stock and the ones that have been paying the dividends and growing them have done better than the overall market. One investment for long-term diversified portfolio, Bob Dahl, what would your choice be this year?
This year, I think U.S. stocks are going to win, so the S&P 500. If you allow me to put an overlay of those companies that have the accelerating free cash flow onto it, I think that's the exciting place to be.
All right. Third year in a row, you think the U.S. stock market is going to outperform the non-U.S. stocks. Ed Hyman, one investment for long-term diversified portfolio?
Well, I don't think exciting is the right word, but I hope so. I like the emerging market consumer, and in that space, we like Ralph Lauren. They address the emerging market consumer, and then in the U.S., as we've discussed, we like dividend-paying stocks that are buying back their shares, and Home Depot is a name that strikes me as being attractive in the U.S. It also is domestic play. So I guess I'm barbelling it. I have one that's really a global play and then one that is a domestic play.
Well, we certainly appreciate two suggestions from you. And before I wrap this up, I want to ask each of the election. How big a deal is the election going to be for your view of what's going to happen in the markets and the economy? Ed?
It's a big deal. It's uncertain. And the research we did presented this week, shows that when you get a change in presidency, the market goes up a lot. In other words, if Obama was to be defeated, that would be a good thing for the market. I don't think he's going to be defeated. So I'm not putting that, it's close, but I'm not putting that as a positive for the market.
How important is the election as far as you're concerned?
I think it's very important. Ed mentioned earlier, fiscal policy post the election. What's it going to look like? We need some fixes here in the U.S., and the makeup of the new administration and the new Congress, whether it's a D or an R, on all sides will be absolutely key. And the uncertainty between here and there will cause lots of consternation.
Ed Hyman from ISI Group, thank you so much for joining us exclusively on Wealth Track, as you do at this time every year. We really appreciate it. And Bob Dahl from BlackRock, from the Wealth Track Brain Trust, we appreciate your being here as well. Thanks so much, both of you. At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's action point picks up on a theme mentioned by many of our Wealth Track guests. It is make sure you own some high-quality, dividend-paying stocks or funds that invest in them, which many of our great investor guests run. In a low-income world, dividends deliver valuable cash to spend or reinvest. They represent financial quality and strength, and particularly in companies with a history of increasing their dividends every year, they protect your purchasing power from the ravages of inflation. I hope you can join us next week. We're going to be talking to Loomis Sayles legendary bond investor Dan Fuss and financial thought leader Peter Fisher, head of global fixed income investing at BlackRock. Where in the world are they finding income? We will find out. And that concludes this edition of Wealth Track. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sayles, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Research Affiliates, an efficient index for an inefficient market.